All right, welcome to This Explainer. Today, we're going to unpack a massive shift that's happening right in front of us. We're looking at how the global push toward net zero is, well, fundamentally redefining global finance and sustainability as we know it. For a long time, environmental initiatives were viewed through a super narrow lens, mostly just as regulatory checkboxes. But actually, scratch that. That era is entirely behind us. The script has completely flipped. And those who truly understand this new landscape are positioning themselves for some absolutely unprecedented growth. Okay, so let's dive straight into this massive number, because net zero is no longer just some mandatory environmental goal. It represents a $1 trillion financial opportunity. Look, when we see a number with 12 zeros attached to it, it definitely demands our attention, right? We aren't just talking about doing the right thing for the planet anymore. We're talking about a fundamental restructuring of capital markets. And this $1 trillion valuation doesn't just materialize out of thin air. It's the direct result of stringent global carbon pricing compliance fully converging with an exploding voluntary carbon market. It represents the sheer scale of the new economy being built around carbon reduction. It's a monumental transfer of value, and it's happening right now. And because of that, carbon credits have officially transformed into one of the most rapidly expanding financial asset classes we're going to see this decade. Just think about that term for a second. Asset class. We're not talking about donations or sunk costs here. We are talking about tradable, valuable assets that absolutely belong on a balance sheet. To understand why, we just need to look at the underlying mechanics. A single carbon credit represents 1 metric ton of carbon dioxide either removed or reduced from the atmosphere. By capping global emissions and allowing these credits to be traded, the market has essentially taken a reduction in emissions and turned it into a quantified, priced commodity with built-in artificial scarcity. It's wild. Just like real estate, equities, or commodities, carbon credits are now a core component of the global financial system, creating a whole new arena for investment and wealth generation. Which brings us to part 1, the strategic divide, laggards versus leaders. So there's a really stark juxtaposition happening right now in the business world. On one side, you have the majority of businesses, and honestly, they're kind of stuck in committee meetings, tangled up in red tape, just trying to figure out what their environmental, social, and governance, or ESG strategies should even look like. They're entirely in a reactive mode. But on the other side, forward-thinking organizations aren't waiting around for perfect clarity. They're proactively leveraging carbon credits right now to pull ahead. They don't see the carbon market as a compliance headache, but as a massive strategic lever that they can pull today to completely outmaneuver the competition. These leaders are actively putting carbon credits to work across 3 very distinct areas. First off, they're offsetting emissions, hitting their environmental targets with tangible, verifiable action. Second, they're using this proactive stance to access green capital. To put that into perspective, take a look at major global hardware manufacturers today. They aren't just buying offsets. They're actually securing billion-dollar sustainability-linked loans at significantly lower interest rates. Why? Because institutional investors are aggressively hunting for companies with robust carbon strategies. And third, they're building a sustainable advantage throughout their entire global supply chains. By demanding carbon accountability from their partners and suppliers, they're essentially future-proofing their operations against upcoming climate regulations. They're building this incredibly wide economic moat, and carbon credits are literally the bricks.
Let's move on to part 2, the new bottom line.
For decades, going green was viewed strictly as a tax on the business. You paid for it, and it just ate directly into your profit margins. But today, the exact opposite is true. Sustainability is no longer a cost center. It is a value driver. By treating carbon emissions as manageable financial assets, sustainability actually generates immense corporate value. It attracts that ESG-focused institutional capital we talked about. It streamlines supply chain efficiency, and it builds undeniable brand equity in a market that flat-out demands action. The organizations that successfully integrate carbon asset management into their core operations today, well, they're the ones destined to lead the global economy of tomorrow. It's a complete reimagining of corporate strategy from the ground up. So I'm going to leave you with a pivotal question to reflect on regarding your own organization's standing in this new reality. How is your organization approaching carbon offset strategies this year? Are you still viewing it as this annoying compliance burden, or are you looking at that $1 trillion opportunity and asking how to capture it? Because the dividing line between the leaders and the laggards is being drawn right now. I really invite you to connect and exchange your thoughts on this strategy below. Thank you so much for joining me for this explainer, and I look forward to keeping this conversation going with you.